Welcome everyone to the Directors Seminar at the Institute for Global Prosperity. I'm Professor Henrietta Moore and I'm the founder and director of the Institute. It's wonderful to have you all with us today. And I'm delighted to introduce our speaker today, who's going to continue the theme that we've been discussing in the last few weeks, which is how we might finance the new forms of prosperity that are so urgently needed. And our speaker today is Professor Daniela Gabor, who is Professor of Economics and Macrofinance at the University of the West of England, Bristol, and her research focuses on critical macrofinance. Professor Gabor is interested in shadow banking activities, in particular repo markets, in other words, short-term borrowing against securities, and the implications for monetary theory, central banking, sovereign bond markets, and regulatory activity. And her two main research projects for the moment are entitled Managing Shadow Money and the Capital Markets Union. In 2006, Professor Gabor was invited as an expert witness at the European Parliament's public hearing on the Capital Markets Union. And her recent research is also concerned with transnational banks and their involvement in policy deliberations concerning capital controls and crisis management, both globally and in emerging markets. And so, as you can see from that brief introduction, we could not have a better guide in this current moment of crisis for what's actually happening in the financial world around us. And I'm delighted to welcome Professor Gabor, and she's going to talk to us today on the theme of the Wall Street consensus at COP26, building a private finance system for net zero. So Gabriela, could I invite you just to start away, please? Welcome.
Well, thank you for the invitation and thank you for that introduction. I hope to do it justice. And let me see if I can share my screen. Yep, can you see it? Yep. Okay, so what I'm going to talk to you about today is a research project which I've been engaged with for the past 2.5 years. It broadly looks at the way in which financial capitalism is reorganizing itself in response to the climate crisis. And I call this political project of reorganization the Wall Street consensus. And what I want to focus on today a bit is the critical juncture at which we are now, which is COP26, that will happen next week in Glasgow. And let me start with with a couple of, well, with some screenshots of what has happened this year. If you were reading the Financial Times and you spent some time on Twitter like I do, you would have seen first that in earlier this year, after Biden won the elections, financial investors in the US were starting to get worried about the proposals of the Biden infrastructure plan. And they started to complain that basically the Biden administration was going back to the 1970s, to the traditional, what we would call in many ways Keynesian spending, public spending on infrastructure plans, an old funded through the government approach. So the idea was that somehow the Biden administration was trying to make a break with the status quo of financing infrastructure and financing, we will see climate as well. And the worry was that this left on the side institutional investors, and I'll explain in a second what do I mean by these institutional investors, but they felt left out, and there was a concern that of the implications, particularly given that they had lots of money and quite a lot of willingness to invest, right? However, from the beginning of the year, when these voices of concern were making themselves heard, both in the corridors in Washington, but on the pages of the Financial Times, what we see now, and this is from last week here in the UK, where I'm based, the Johnson government organized a Green Investor Summit, preparing the groundwork, as it were, for COP26. And we see the same investors that were complaining earlier this year for being left out. They were back on the sort of back on the table. And here are four, unfortunately, white men, but not, and we can discuss why, the bosses of what we call some of the largest institutional investor or asset management firms, mostly from the US. And we'll come back to that. I think BlackRock and Larry Fink is quite interesting in this story, but not only him. So they were back on the table, and BlackRock in particular, the president of BlackRock last week or 2 weeks ago wrote a quite influential piece in the New York Times arguing that high-income countries had to do more in preparation for COP26 and had to announce at COP26 that they would meet their commitments, and these are long-standing commitments that have not so far been met, to provide $100 billion a year in grants to low-income countries in order to support climate finance, in order to support their transition to a low-carbon economy, particularly taking into account that this transition is going to be expensive for a variety of reasons, and we'll discuss why. But the request was to make sure that these countries will bring to COP26 $100 billion a year, one way or another. And we, yesterday or 2 days ago, the COP26 presidency released the plan for delivering this $100 billion a year, led by Germany and Canada. And this plan, in a sense, has some of the keywords of what I think is the fundamental anchors or pillars of the Wall Street consensus. And I'm giving you here one quote, which is, the logic is, yes, we will deliver $100 billion a year, but we have to bear in mind that the low carbon transition and climate finance requires private investors. And the question is, how do we bring private investors in here? And the key magic word here is de-risking. And I want to think through what does de-risking mean here, and what is the political economy of the de-risking project that we're seeing sort of formed and evolving for quite some time now, but at COP26, I think its logic will be reasserted again. So these are the kind of keywords that that I would have taken from simply reading through the newspapers and financial media, which is institutional investors are very important in the story of how we finance the low carbon transition. There are specific mechanisms for financing that, and there are specific relationships with the state captured by the buzzword public-private partnerships. And I will come back to this PPP or public-private partnerships again, and the logic of de-risking within that. So to take a step back, in order to make sense of the way in which we are thinking about the low-carbon transition, there are estimates that what we need is 5 to 7% of global GDP to be invested per year up to 2050 in order to deliver on the some of the net zero commitments that most countries have made. And there are two ways to organize that in macroeconomic terms, right? One is to say, well, we will maximize private finance. We will make sure that we redirect financial flows from high carbon activities towards low carbon activities. If we can convince the BlackRocks of the world and pension funds, insurance companies, banks, if we can convince them to lend less to high carbon activities or to fossil fuel companies and to lend more to, say, renewable energy companies or to sustainable transport, then we will have the kind of low carbon transition, and we will reduce the carbon footprint of economic activity in general. So that's one logic, to say we have the money, we just need to make sure that it goes into the right places with private finance. And the second option is, well, we cannot rely, or the second logic is to say we cannot rely on the market, as the first kind of option proposes, or we cannot rely on financial markets to deliver the low carbon transition. What we need is a lot of public investment. We need the state to expand its balance sheet again, to move away from the logic of the last 30 to 40 years, particularly in high income countries, of of a slimmer, shrunk state, at least in terms of its direct interventions in economic activity and in the allocation of economic resources. What we need is a big state again, and this big state will do a lot of green public investment, and that will make sure that we have the low carbon transition that comes also with justice, with economic and social justice, that doesn't leave behind the workers that are going to lose out, that protects households and businesses from some of the costs of the structural transformation. I think this is something that we need to be very clear about, that no low carbon transition comes without losers. This is a very important question. And the political economy question here is, who are these losers and who decides who they are? And just to give you a sense of why the first narrative or the first political, what is the political appeal of saying and arguing that we need to work with BlackRock or Blackstone or asset managers, the governments in general look at this graph that I'm showing you here, and what they see is that institutional investors and their asset managers, and by institutional investors, I mean pension funds, I mean insurance companies, I mean endowments, I mean family offices for high net worth individuals, I mean multinational corporations who have large cash pools that they sit on. So all these institutional investors together, they sit on large pools of capital, and they typically will give these large pools of capital to asset managers like BlackRock to invest on their behalf. So we have, by the latest estimations, we have around 100 trillion in assets under management. These 100 trillion are mostly managed from the US and on behalf of US institutional investors, but also Europe, Japan, and the rest of the world are important. And the logic here is very important. These 100 trillion, if they go into the right places, if they finance the right green sectors, then we can get the low carbon transition finance without changing much of either the macroeconomic paradigm that we've had for the last 30 years or the distribution of political power or the status quo. So this is, in a sense, a good starting point to think through what is the appeal of a political narrative that says you have to maximize private finance, you have to organize the private financial system for net zero. It's the logic of trillions that could go into, if they are properly directed, they could go into the right places. So what I want to think through, and what I've been doing for the last couple of years, is to think through the question of how and why has big finance, and by this, I call it big finance also because these institutional investors and their asset managers are highly concentrated. For example, BlackRock is managing 10 trillions, almost 10 trillions of assets. The next asset managers are also very big. So it's quite concentrated. It's quite powerful politically. And what I want to think with you today is how come that big finance has acquired such an important role in the low carbon transition, and what are the implications, right? So we will try to address these two questions today. And in order to think through this question, I'm using a theoretical framework that I call critical macrofinance that I've developed with several others over the past couple of years. And this critical macrofinance framework starts from noticing the structural changes in modern finance that have taken place over the last 30 to 40 years. That is, it doesn't rely, as we typically do, on the idea that we live in a financial world where banks are dominating. And what banks do is they give loans. In the process, they create deposits. Deposits are a public good because they're the money we use to pay each other. That's the end of the story. What we see instead in terms of structural transformation is that we have US-led financial globalization. And that's not a very sort of controversial statement to make. We have US-led financial globalization, and that comes with a particular change in the makeup of financial markets towards what we call market-based finance. And I can elaborate on this if it's important, but what we typically mean by market-based finance is that credit is created through capital markets instead of the balance sheet of banks. And by that, I mean credit is created through bonds or through equities or through other types of tradable instruments, and increasingly also through private markets. And we can talk about the role of private equity. So credit is increasingly created through capital markets, and it is financed through what we call wholesale money markets, or the repo markets that we heard about earlier, and through derivative markets, right? So it's a financial system that is far more complicated, and the ecosystem is far more complicated than the traditional banking story. And the logic, or the reason why this occurs, is that we've had a push towards what I call the Americanization of local financial systems. In other words, for the last 30 years, we can very clearly trace the way in which first the countries in Europe, but then countries elsewhere, have started to increasingly resemble the financial architecture or infrastructure of the US financial system. And there are reasons why this is the case, but I'm not sure that we can discuss them. They're not so important to address here. So this is what we have. The world is starting to look more and more in financial market structure like the US. In order to think about how it operates, critical macrofinance thinks about interconnected and hierarchical balance sheets, but I will not subject you to that today. This is part of monetary theory, and it's quite interesting. Credit creation occurs through bond markets, as I argued, and it also involves new forms of money. And these new forms of money are very interesting to study, particularly for people like myself who are interested in central banks. But why this matters, I think, in terms of the political economy of the low carbon transition, is that as we have structural changes in finance, we have also new pressures or new requirements on particularly central banks to create or rely on new instruments in order to stabilize this financial system, right? And this is an insight that comes from Hyman Minsky, which is a quite well-known theorist of financial capitalism and the post-Keynesian, and he argued monetary policy, for example, needs to change, or what central banks do needs to change in order to reflect or to capture and address structural changes in finance. You basically, central banks have to evolve in line with private finance. And the changes that have occurred over the last 15 years, I call them, both in monetary policy and increasingly in fiscal policy, I call them, or I think about them under the umbrella of a de-risking state, in the sense that the state, through fiscal and monetary policy, introduces new instruments to stabilize the value of both the assets of the financial system and the liability. So if you think, for example, of QE, that's a very good example, not only of an unconventional monetary policy instrument, but it's a good example of the way in which the state is responding to the structural changes in financial markets. And the story is not only that the state has to stabilize new forms of money or new types of systemic liabilities, but also that the state becomes a partner with private finance in creating new asset classes, right? And what do I mean by that? New asset classes or new financial instruments that institutional investors and asset managers can hold on their balance sheet and can generate returns for them. Green bonds is an example where the state works with private finance in order to make sure that there are stable returns and liquid markets for them. Housing is becoming an asset class. If you think about private equity funds, nature is becoming an asset class. In COP26, we have conversations about them. There is a project of expanding the reach of the financial system into areas of social life that were not previously, let's call them financialized, because, and the story here is also well known, if you ask, for example, pension funds, why do you invest in residential housing in Berlin? They will say, well, our usual assets or our usual instruments that we hold, which are government bonds, are not yielding enough because central banks buy them, they reduce the interest that we get on them. So we have to go where there is a little bit of return because we have pensioners to support, right? And because we have pensioners to support, we are looking for new asset classes that generate some return for them. So I argue we have, and I'll show you in a second, that we have a project of a de-risking state which changes the nature of monetary and fiscal policy. but also that asset managers and institutional investors are acquiring new forms of infrastructural power, in the sense that the state is increasingly reliant on private finance to implement policies that were traditionally simply a question of the social contract between the state and citizens, right? That, for example, for housing policy, it's a good example. But if you look at the way in which monetary policy is being implemented these days, you very quickly see that the central bank relies more and more on private finance and on market-based actors in order to implement monetary policy. And this creates a series of entanglements that are interesting to think through if we are thinking about the reforms post-2008 of shadow banking, for example, or the reform of the global banking system. Lots of financial regulatory agendas have been shaped by this infrastructural entanglement between the state and private finance. I'm not going to focus on that today, but well, that is something that is very interesting to observe in the global north, and Ben Brown has written a lot about it. What we see in the global south is a form of entanglement that I call this the Wall Street consensus. And there is a paper that I published in the journal Development and Change that elaborates on this, and I want to spend a little bit of time sort of mapping the argument of that paper and then trying to ask the so what after the paper. What have we seen since then? And to understand the logic of the Wall Street consensus is to go back to a quote by Jim Yong Kim, who was then the president of the World Bank Group. And this is a quote that I think is quite insightful, in the sense that it articulates the logic of the Wall Street consensus. And it says, well, we don't live in a world where the state can deliver, particularly states in the global south or governments in the global south, they cannot deliver on the set of promises to their citizens in terms of public goods. They cannot provide education. They don't have enough resources to provide education. They don't have enough resources to provide health. They don't have enough resources to provide infrastructure, particularly renewable energy. So what we need to think instead is not how do we get more resources for the state, because this is a question that we have not been able to solve for the last 30 years. We have to ask ourselves, why is private capital not there? In other words, why doesn't BlackRock or Amundi or any other asset manager, why doesn't private capital finance a renewable energy plant in, say, Morocco or Zambia or Kenya? And the question is, and the answer is, in this narrative, well, asset managers don't go to countries in the global south because they have a preferred risk-return profile for the kind of projects they invest in, right? And in most countries in the global south, they would really like to invest, but the risks are too high related to the returns, right? And the logic here is, for the World Bank Group, well, we as multilateral development banks and in general international development, what we should be doing is to try to change the balance of risk and returns in development projects. And if we do that, then we can have some of those trillions that are floating around in assets in the global north, they can come to countries in the global south. And by doing that, they can finance what we call SDG, Sustainable Development Goals development, right? So here is, I think, in this very short sentence, we have. Say again? I heard somebody saying something.
I think that, and don't worry, Daniela, I think just continue. I think that was just a random sound from someone who wasn't on mute. Don't worry.
Okay, good. It gives me a chance to draw my breath. Okay, so this is the logic is we have to de-risk projects, sectors, and entire countries. And by de-risking projects, sectors, and countries, the World Bank means to change the risk-return profile for institutional investors to go to countries in the global south that need private investment. Okay, and this is, I think, the logic that you can find in the World Bank's new, it's since 2017, it's probably not so new anymore, the Maximizing Finance for Development agenda, but there you can find the same logic in any multilateral development bank that you read of. The United Nations has the same logic. The COP26 has the same logic as I've just shown you. And the idea is that sustainability can be a profitable business for institutional investors as long as there is some partnership between the state, between the public and the private, in order to change the risk-return profile of development projects. That's another way of saying we have to turn development into an asset class to make it attractive to institutional investors. If we do that, then we don't need to worry about the resources that the state has in the global south. What we will get the trillions that we need for the SDGs to become a reality. And actually the G20 had a program called From Billions to Trillions that was part of the Addis Ababa conference. And it is exactly this logic. We have billions trickling through to the global south of institutional investor money. We need to make them into trillions. We need a de-risking agenda for that. We need to de-risk projects, sectors, countries, as Jin Yong Kim put it. So what does this de-risking project look like? Or what does it mean? It means that the institutions of the state need to change in order for the state to provide the instruments that de-risk development assets, that de-risk development projects. And I give the example in the paper of the institution that I think originates this logic, the KfW in Germany. This is not the typical institution that you think is an arm of financial capital, but I think it's quite an interesting story of the role that it plays. And in order to de-risk this new asset, to create this new asset class, that would achieve the SDGs, we see a return to public-private partnerships. And PPPs are quite well known in Europe. They are sort of partnerships between the public and the private sector, where the public sector says, I'm not going to build a hospital on my own. What I would ask you here in the UK, I think they were called PFIs. I'm not going to build a hospital on my own. I will give it to the private sector, right? So this is the private in the public-private partnership, but I will assume some of the risks on the balance sheet of the state, and the private sector will keep some of the risks. So we are sharing the risks under the assumption that the private sector is always better at building at least public infrastructure. But it won't do it without a little bit of help from the state. So that's one element of this Wall Street consensus, to put in place the mechanisms for de-risking from the state. And the second one, which I don't want to spend a lot of time on because it's a bit technical finance, is there is also a structural transformation of financial systems across countries in the global south, because institutional investors need to have particular types of markets, and they need to have particular types of financial infrastructures to be able to enter and exit positions there. And to give you a sense of what this means, I think more visually, remember that I showed you at the beginning a graph with the comments around the Biden infrastructure plan and the complaints that Biden was freezing out institutional investors. So if we think about this logic of what would a low carbon transition or green public infrastructure, what would it look like if it was financed directly by the state, as Biden originally intended, although it's not going to happen like that anymore? Or what would it happen, how would it look like if it was financed by through the private financial system? And on the left-hand side, you see what a maximizing public investment for the low carbon transition looks like. And the role of the state is very clear there, right? What the state does is traditional, as the Financial Times article put it, it just does traditional investment in infrastructure. It builds roads, it builds renewable energy plants, it builds, I don't know, the infrastructure for charging electric cars if it believes that electric cars are an answer to the problems of fossil fuel transport. And it provides these public services to its citizens, right? Whereas the role of private finance in this story is, in a sense, a very simple role, and a very traditional role, which is to say the state will borrow money from private financial institutions by issuing sovereign bonds. It's a very, very sort of traditional set up, the state can sell sovereign bonds or it can sell green bonds to the private financial system, and citizens will pay taxes. Sometimes they would also pay user fees, but in general, not as much. Whereas in the logic of the Wall Street consensus in yellow here, the infrastructure that, is being built and is being transformed into assets to be held by institutional investors through public-private partnerships, right? And these public-private partnerships come with what Katarina Pistol calls coding capital practices, which is that, for example, in Morocco, when the state engaged in a PPP with private investors to build renewable energy plants, they write contracts that specify the division of risks between the private sector and the state, right? And these contracts typically look at who assumes what kind of risk. And in PPPs for infrastructure assets, and we know this with COVID now, you have demand risk, which is the risk that the demand for infrastructure falls. And why does this matter? Because infrastructure assets come with user fees. A PPP hospital will charge user fees, a PPP highway will charge tolls, a PPP school will charge fees for children, etc., etc. And these fees are necessary because they create the cash flows that go to service the private finance. Because they are assets, they need some underlying cash flow, right? The private financial institutions buy these assets, or in other words, give credit to the company that builds the PPP school or the PPP hospital, because it expects a regular cash flow on a monthly or yearly basis. So we have this logic of commodifying public goods baked already into the PPP infrastructure assets. But of course, if you have a COVID-19 crisis, or if you have an extreme physical event because of the climate crisis, people might not be able to go to school and they stop paying user fees. People might not be able to pay the user fees for the hospital. They might not use highways anymore, and therefore they won't pay the tolls. And then what the PPP contract says is who assumes the responsibility if this happens? Who pays for this? And in PPP contracts, that's typically the state. The state says, well, in order to make sure that BlackRock or private finance comes into my PPP infrastructure assets and finances this hospital or finances this school, I need to make sure that I shield BlackRock from the possibility that demand fluctuates. So if my citizens don't pay user fees, I will pay from my own fiscal resources. And there are various examples that I give in the paper, ranging from Ghana's independent power producer PPP contract, in Nigeria, another power plant. There are several other examples of hospitals where the state, when demand risk materializes, the state pays, basically, right? But it's not only about demand risks. There is also, and this is, I think, far more interesting in many ways and far more challenging, climate risks. In other words, if you have extreme physical events, then these infrastructure assets will not be able to generate cash flow for institutional investors. And then what you need is the state to basically compensate investors for climate risk. In other words, what we have here in this Wall Street consensus is a strategic repositioning of the private financial system to protect its balance sheet from both capitalism, in a sense, because if you think about the way in which capitalism works, the idea is that as a private company, you are better at or you compete against your competitors in the market, and if there are demand fluctuations, it means that you're no longer competitive. But here the logic of competition disappears because the state says you don't need to worry about what happens to the demand for your products. I will guarantee it. And that's I think it's quite a challenging approach, both for the state, but also for the health of the capitalist system. So that is on the fiscal side, right? And I think I know there are several people who are looking at various PPP contracts and trying to understand the distributions of risks. What we know since COVID-19, because it created such a massive materialization of demand risks across countries. What we know is that the World Bank, for example, says we need to think about rewriting PPP contracts in a way that the state assumes even more of the risks that are inherent in PPP contracts. And I think it's quite interesting to study that. But we also know that on the monetary side, the central bank is also expected to assume both the risk attached to the liquidity of financial instruments or of bonds that finance the SDGs, right? And you can see that, for example, with the various responses to the COVID-19 crisis in countries in the global south that started buying government bonds. That's a form of de-risking to me. It's not a form of supporting the state. It's a form of shielding institutional investors that were holding these bonds from liquidity problems. But more interesting is how the central bank would react to climate risks. And we will get back to this in a second, just to have a sense here that the Wall Street consensus is reclaiming and trying to transform the state. It is a project of state building, but it's a very different kind of state than the one that we have in mind, right? When we think about the state and we debate the politics of the state here in the UK, for example, we always think, well, will the state spend more? Will the state spend less? What happens when it doesn't? Will it increase taxes or not? But in the logic of the Wall Street consensus, the state does very different things that we really struggle in a sense to keep track of, because they are hidden in legal documents. They are what we call contingent liabilities. These PPPs generate contingent liabilities, and they are off the balance sheet. They are hidden away. They might become more transparent because there are financial institutions that are trying to, particularly the IMF, that is arguing for more transparency, because of course, the more risks you're assuming, the more you're shielding investors from capitalism, the more expensive the higher the burden on your fiscal resources, up to a certain point when you can get into debt crisis. And there are international financial institutions who have the responsibility of at least monitoring the way in which the state makes fiscal commitments. So I was going to give you a couple of examples, but I see I already did 40 minutes or 30 minutes. There are a couple of examples of the way in which this logic of de-risking has been used in the World Bank's Maximizing Finance for Development agenda. And here there is an example from Tunisia, from a PPP to build a new port. And this is the logic of de-risking, is to say, well, if the private finance is not coming in, we need regulatory de-risking, and then we need fiscal de-risking. We need to change the balance of risks and returns. And in the paper that I just referred to, I also map in more detail the kind of regulatory de-risking and fiscal de-risking that we can see in what the World Bank calls its new infrastructure structural assessment programs. It sounds a bit of a mouthful, but this is already the World Bank is taking steps to map out what would these de-risking instruments look like in order to make sure that the project of creating investable assets in order to advance the SDGs sort of proceeds. And besides this sort of logic of having the state do de-risking, I think the Wall Street consensus, and I chose this term because I wanted to make a parallel to what we know and is much more well known, the Washington consensus, which is a paradigm in place since the 1980s. Some people call it neoliberalism. I prefer to call it the Washington consensus because it is very well known, and because it has its 10 commandments, as it were spelled out by John Williamson in 1991. And they are a set of policy prescriptions of what are the key ingredients of a successful market economy, right? And the key ingredients were in the Washington consensus to make sure that the state is fiscally disciplined. In other words, it doesn't run high budget deficits, that the central bank is not subservient to the state and to politicians, but it's independent, to reduce public spending to a very narrow set of activities, for example, primary education, primary health, public infrastructure, There were calls for tax reform in the early 1990s. And then very important, there were a set of policy prescriptions that had to do with the macro financial architecture. That is, what is not only the fiscal authority supposed to do, but the central bank. And this Washington consensus was also, in a sense, a policy paradigm that responded to the previous hegemonic narrative of how you organize your macroeconomic policies, which we call Keynesianism, or in the global south, we call the developmental state, right? And that developmental state very much had the logic of, I'm going to organize economic activity, and I'm going to structurally transform my productive system in order to make sure that I am externally competitive and I go up global value chains. They weren't called global value chains at the time, but you wanted your exports to be more competitive and to have higher value added. And the Washington consensus replaces that paradigm of a very large state organizing economic activity with a much more, with a smaller market-based state, with a market-based financial system. And I'm singling this out here because I want to think with you of why I think that the COP26 is going to mark a change and the beginning of what I'm going to study next, which I call carbon shock therapy. I want to make a parallel with the shock therapy in Eastern Europe, right? So and also because I'm Eastern European, I'm from Romania. And in the 1990s, the Washington consensus was applied to countries in Eastern Europe under the heading of shock therapy that said, well, you have a centrally planned economies that need to become market-based. They really want to embrace capitalism. The socialism or central planning didn't work. What we need to do is every prescription of the Washington consensus needs to be implemented, starting from price liberalization, trade liberalization, also accompanied by fiscal and monetary austerity. And if we map these 10 prescriptions against what are the policy recommendations of the Wall Street consensus, what we see there is a lot of continuity, right? A lot of continuity. We have the same logic of fiscal discipline. We have the same logic of central bank independence, even if the central bank is doing so much more now than it did in the 1990s and the 2000s. Very important, we have here public spending is reoriented increasingly towards fiscal de-risking asset classes like the ones that I've shown you before for global institutional investors. Infrastructure as an asset class is already a program of the G20. Nature as an asset class will become far more important. And quite interesting in terms of the obsession with tax reform that we had in the Washington consensus, which said, well, you have a gray economy, you need to bring it to the open. How do you do that? You make sure that you tax people and you tax businesses properly. What we have now is sustainability reform. The idea of we have to identify what are green investments or green capital flows or green assets and what are dirty. We used to call them brown. We don't anymore for a variety of reasons. What are dirty assets? And that's important because you need to be able to identify which kind of economic activities should receive investment and which shouldn't, which kind of asset classes will help the low carbon transition and which kind of asset classes might actually worsen the climate crisis, right? Very important, there is also a change, and I'm going to focus on 3 of the list of 10 because we don't have time to go through them, but besides coming up with new grammars and new languages of what are good assets or what are green assets, what is green lending and what is dirty lending, we also have an incredible pace of change in central banking with respect to the climate crisis. And I want to focus on that because I think that's where COP26 will be important and we should keep track of. Central banks are increasingly talking green, but I want to think about if they are staying within the paradigm of the Wall Street consensus, what does it mean for central banks to say, we have a responsibility to green? In the UK, the Bank of England now has an environmental mandate. The European Central Bank has also very recently said we will need to decarbonize our balance sheet, we need to decarbonize our activities. So I'm going to focus on that second point, and then I want to think through the concept of carbon shock therapy, which is kind of new, but I think it's an important insight into what I think would look, how the next 5 years might look like, or 10 years for countries in the global south in the context of increasing, I would say, debt distress. A lot of countries in the global south are going to go through a very difficult time towards the end of the pandemic. So let me do this quickly. I'm assuming this is you're already familiar with a lot of this. For the last 3 years, but it's been longer, but for the last 3 years, it's become very public. We have seen a turn to ESG ratings, or environmental, social, and governance ratings, in the sense that financial institutions or private finance itself has recognized that beyond impact investment, which used to be a niche activity, it needs institutional investors, particularly pension funds, because they have fiduciary responsibilities, but institutional investors in general need to be able to work out how much of their assets will suffer if the climate crisis becomes immediately real. I mean, if tomorrow you will have a very significant flooding somewhere, or you have a typhoon, or you have whatever you do, how do I know that which parts of my balance sheet, which of my assets, the credit instruments that I hold and generate revenue for me, how do I know whether these will be affected by the climate crisis? And this sort of epistemological question has been answered through this turn to ESG ratings. And that's another word for that is a taxonomy of green and dirty, which is a way of thinking through some assets serve a good purpose in the sense that they are green. They have a local, they are lending, they capture lending to companies that perform well on environmental standards, perform well on social standards, and have good governance practices, right? So if I have a AAA rated, ESG AAA rated company as an institutional investor, I have every reason to believe that a serious climate event will not impair that asset, would not affect the cash flows of that asset. Whereas if it's very low rated, if it's CCC rated, it's probably going to become stranded, in the sense that the company that has issued that asset to which I lent, that company is not going to be able to pay me back. If it doesn't pay me back, that is a loss for me, right? So that this ESG framework, which is very interesting, is increasingly used in order to distinguish between the parts of the balance sheet or the assets that institutional investors hold that are green, and the assets that are dirty or that are used to lend to fossil fuel companies, or that might become stranded. And the private taxonomy, this ESG taxonomy, was the first one to evolve. But if you followed, the European Commission has proposed a sustainable finance taxonomy that basically does the same. It's a way of identifying or distinguishing between credit flows going into low carbon activities and credit flows going into high carbon activities. However, what we know, and here I'm giving you some examples, what we know, and it's very well known in the central banking regulatory world, is that ESGs, private ESG ratings, because they're provided by various institutions that charge a fee in order to generate them, they are very prone to greenwashing. And we can have a debate there whether greenwashing is a feature or a bug. I think it's a feature in the sense that the incentives that the private financial system has to properly green itself, or to identify the subset of assets that are green, are not there. In other words, there is a systemic incentive to pretend that some assets are greener than they actually are. And we know that, at least anecdotally, we know that, for example, by comparing the ESG scores from two of the largest providers, which are FTSE and MSCI. And you can see here, there was an example of Tesla, for example, that had a very high ESG rating from one provider, a very low ESG rating for another. And of course, that's great, because depending on who asks me, if I'm an institutional investor, I can show them the high ESG rating or the low ESG rating, particularly if a regulator asks me, a regulator that says, I think you should be have higher ESG ratings of your assets than lower one. So what we have in this private ESG space is the potential for greenwashing. And this, it matters if we think within the logic of the de-risking state, because properly greening your balance sheet, properly greening your assets means that you might have to either give up some of the profits or accept lower yields, or you might have to incur some losses. And if and for private financial institutions, which have particular incentives to generate profits, it pays to greenwash if you know that the state will bail you out. Okay, and this is what the de-risking state might have as a potential to do. It might end up bailing financial institutions that are doing greenwashing because there are no public, significant or substantive public efforts to make sure that finance decarbonizes. And I want to think now about this question, because if I say this to a room of central bankers, they will say, "Oh, Daniela, where have you been for the last 3 years? Have you not seen what we've been doing?" And it is true that if there is one actor in the kind of public space that has talked a lot about decarbonization and about the low carbon transition, that is the central bank. And just to give you a couple of examples here, I have here one of the proudest moments of my life. In many ways, I did not plan it, but it happened. We wrote a paper on how the European Central Bank could decarbonize its monetary policy framework, what we call the collateral framework. And we wrote it with somebody from Greenpeace, and then without knowing, the Greenpeace had organized a paraglider that took our report to landed it with a paraglider on top of the ECB building, and for a couple of hours on Twitter, everybody talked about why isn't the ECB greening itself in the way that we were suggesting to do. And I think some people in the ECB were a bit upset about this, not only because it was a publicity stunt. I mean, it was, but I think publicity stunts are important now because this is a very serious issue, but also because Christine Lagarde, the governor of the ECB, has been unusually forthcoming in trying to push the European Central Bank and the political debates around the role of the ECB into a decarbonization agenda, right? And that's not only the ECB, although the ECB, I think it's at the forefront together with the Bank of England. But if you check the network for greening the financial system, that is a network of central banks that for the last 6 to 7 years have been doing a lot of work into thinking through how do we think as central banks about the question of the climate crisis. And here again, the devil is in the detail, and I want to spend some time thinking about this. Is not in the paper already, but developments over the past 3 years are very important to think through, or to take a step back and think theoretically through. Are we seeing central banks, which I've argued have become a very important institution of the Wall Street consensus, in the sense that they are accommodating and de-risking the balance sheets of private financial institutions? Are they changing this partnership with private finance when it comes to the climate crisis? And the intuitive answer is to say yes, right? Because central banks are talking so much about the climate crisis, it must be that they are prepared to take a much more firm stance, to be much more bold in decarbonizing the financial system, okay? And here I want to think through two approaches that we have seen emerging, or two possibilities of how to green central banking that we have seen emerging over the last 3 years. And I won't have time to spend to talk a lot about them, but we can come back to them in the question and answer session. The approach that makes sense within the political economy of the Wall Street consensus is the climate risks approach. And that's the approach of the Network for Greening the Financial System, which is almost 100 central banks from all over the world. And that approach says climate is a legitimate issue for central banks. We have to talk about the climate crisis, but we talk about it because it's a financial stability issue, in the sense that if there are repeated and increasingly significant climate events, then we have financial stability risks, simply because, you know, a flooding or 5 hurricanes, or the fires that we have seen in the US, or the fires that we have seen in Australia, they are destroying or affecting the performance of economic units to whom banks lend. So basically, simply by virtue of the fact that you have extreme climate events, you have financial stability risks. So the central banks would argue it is our responsibility to protect the financial system from climate risks because we have a financial stability mandate. Okay? Whereas in particularly for the Bank of England, which has a more explicit environmental mandate, at least since this year, there is a different approach, which comes within the logic of double materiality. Again, a technical term that comes from these taxonomy discussions that we had at the European Commission. And the double materiality, although it is quite intuitive, and it says, well, you have the climate crisis and you have the financial system. And the way in which the central banks think about it is from the climate crisis to the financial system. The more extreme the climate crisis is, the more financial stability risk for the private financial system. But the double materiality approach says, well, we have to think the other way as well, in the sense that if banks and asset managers and institutional investors continue to lend to Shell, Total, and other fossil fuel companies, then you also have a climate footprint of private finance that is increasing and increasing, and the financial system itself contributes to the climate crisis. It's not just affected by it, but it contributes to it. And whether you as a central banker think through a double materiality approach or a single materiality approach makes a very significant difference to how you will approach the question of decarbonizing your monetary policy operations, and in general, decarbonizing the financial system. And the logic of the Wall Street consensus, and we know, for example, from BlackRock lobbying in the European Union and the European Commission, the logic of the Wall Street consensus is that it likes the single materiality approach, right? It likes to say, well, I need to be protected from the climate crisis. Whereas the logic of double materiality comes more from the public sphere, and it says, well, we also need to make sure that BlackRock stops lending to companies that are doing deforestation in Brazil, which we know they are doing. This is a way through which private credit creation is accelerating the climate crisis. And what we are seeing in the central banking space is a political struggle between these two approaches. And it is a political struggle that the Wall Street consensus is winning, in the sense that the climate risk approach is increasingly dominating the way in which central banks are thinking about how to react to the climate crisis. And in this table, and there is a paper that will come out soon that I co-author with three other colleagues, Yanis Dafermos, Maria Nicolaidi, and Frank van Laveren, with whom we've written several other papers around decarbonizing central banks. We are comparing these two approaches, particularly because it tells us something very specific about the nature of state responses to high carbon lending by the private financial system. And just this is the only thing that you should take from this table now, is that in the climate risks approach, which is also the one promoted by the Network for Greening the Financial System, central banks only penalize dirty lending if there is a probability that the company that receives this dirty lending will default, right? If the company, there are scenarios that central banks are putting together, and if there is a high climate crisis scenario under which, say, Shell defaults or Total defaults, then I'm going to protect the financial system by basically making it more expensive for financial institutions to borrow from the central bank against the bonds issued by that company, which is called haircuts on collateral. It doesn't matter the terminology, but the logic is there. And what we know, and here is a tweet from yesterday, what we know that this is in a sense quite a perverse logic, because if fossil fuel companies are doing very well, if they're sitting on large piles of cash, their probability of default is very low. So the incentives for central banks to react in this framework are also very low. And therefore, greening central banking within this Wall Street consensus approach is actually a policy that has a very scary rhetoric, but very little material consequences, very little material consequences. And where it has material consequences, it is that it can amplify the activities or actions of the fiscal authority. And here again, the other thing you should take from here is that central banks, because they come from the logic of independence in the Washington consensus, and it perpetuates in the Wall Street consensus, central banks say, if there is one policy that we should all be supporting and we wholly embrace, is fiscal action through higher carbon prices. So when you hear higher carbon prices or carbon taxes, and at COP26 we will hear that over and over again, this is the preferred avenue of a sort of the status quo political arrangement that we have. It is to say, if you increase carbon prices, then the central bank will protect the financial system from possible financial stability actions, because it will make sure that companies that can default, that are affected by high carbon prices, will also not be receiving lending from financial institutions. And I think that's really a really interesting turn of events that although we could have the central bank doing lots of things, and it should be doing lots of things in order to decarbonize the private financial system, we do not, at least the political moment that we are now, we are not going to get monetary decarbonization. We probably will get fiscal decarbonization through high carbon prices, and that is, I think, in many ways, the least productive way and the least effective way to decarbonize economy. So I'm hoping at least I will convince you that you should resist the logic of higher carbon prices, because it comes with a particular political economy of the other policies that will or will not be implemented in order to accelerate decarbonization. And I'm going to finish with this. It's very interesting that business leaders that are coming at COP26, and by this I mean large business lobbies, they are embracing global carbon pricing, right? And you should think, well, this is great news, right? If we make it more expensive to emit, increase emissions, then we will have capitalism responding to price signals, right? This is the logic. This is a market-based approach. Just make sure that carbon prices are increasing, and there are many ways in which you can increase carbon prices. But I think this is in many ways a very self-defeating strategy. And to make that point, I want to just remind you of what we know about changing price signals from the experience of the Washington Consensus under shock therapy. And that experience was to say we need transition, and you see the wording is similar. I've been thinking about this for the last 3 months because I was reading and listening to Isabella Weber's new book on how China escaped shock therapy, and this is something that we want to develop together. And the same vocabulary of transition that we had in the early 1990s, we have here now when faced with the climate crisis. And the same objective is there. We want structural transformation of our productive system, and we want to change price signals, right? Increasing carbon prices is basically a way of using the market to signal to companies that they should produce less of this and more of something else, okay? And this was the same logic that was used in order to try to subject state-owned companies that were coming from central planning to the disciplining hand of the market. And what did it look like? Well, they increased the prices, or this was price liberalization. They increased the prices at which state-owned companies, they could import the intermediary goods that they needed in order to produce stuff, but the prices at which they could use energy. So we have the same logic here of increasing prices, but we also had increasing the price of credit via monetary austerity, right? So lots of central banks in Eastern Europe, when they did shock therapy, they restricted or increased the price of credit. And these were imposed, these shock therapies were typically imposed after 1990s through the World Bank and the IMF, which are very important institutions in the Wall Street Consensus as well, when you had balance of payment crises, in local coalitions with the central bank, and against political opposition and contestation locally, because it came with a lot of job losses, right? So if you think about the rhetoric of the just transition, it is the same logic that we had in the 1990s, is that structural transformation of economies creates winners and losers. And the losers are typically workers in the industries that will not respond to price signals. And we have the same, I think, makeup for carbon shock therapy in the Wall Street Consensus. And Germany is a great kind of sort of political actor that mobilizes this discourse. And the idea is we have to increase the price at which companies pollute. If they want to pollute, okay, but it has to be very expensive. But also we will have to increase the price at which they get credit to do so. If, and this is under the climate risk approach, if and only if they will, they are in the process of or under the danger of defaulting. And we see, and I've started to read, and this is the, part of the future research that we have to look, that I'm engaging in. I've started to look at whether this is already part of the way in which the IMF and the World Bank is thinking through its new climate framework. And there are new climate frameworks that are coming both at the IMF and the World Bank. And here I show you the July 2021 new paper of the IMF on what will its new climate framework look like. And if you read very carefully here, there is a logic of carbon shock therapy. It is the logic of, if we have to help countries that have suffering from a balance of payment crisis, we are not going to ask them to increase public investment in green industries. When we think about climate considerations, we are going to ask them to increase carbon prices one way or another. So we will have the kind of green conditionality that some people have been writing about within the logic of this Wall Street consensus that you need to discipline local productive systems into polluting less one way or another. And we see, and I think this is interesting, if anybody is studying the reallocation of newly created SDRs by the IMF, this, instead of being an opportunity for countries in the global south to get some resources from this global pool of money created by the IMF, it will become a Trojan horse for green conditionality and carbon shock therapy. This is my worry. I'm not sure it will happen or not, because we still don't know the details, but at least the IMF paper points into that direction, that it will have to finance climate supportive measures. And by climate supportive measures, they mean carbon shock therapy. There is an alternative, but I might not have time to deal with it. The alternative is to have a complete reorganization of both the way in which the state organizes its interventions in economic activity, and that means you have to assume as the state responsibility for distinguishing between green and dirty assets. You have to have green public investment, as the Biden administration wanted to have at the beginning of the year. You have to have a green industrial policy. We talk in the UK a lot about green industrial policy, but it's not really at the scale that is necessary for the low carbon transition. You need to have progressive taxation. You need to have stabilizing wage policies, and inflation now it's quite an interesting sort of a change in the makeup of the political moment that we have. And you need a monetary policy to be far more muscular in decarbonizing the financial system. So it has to have a double materiality approach or a carbon footprint approach that I showed you earlier. I will leave you with these questions. Sorry, I didn't think I could talk for this long, but listen to me.
Fantastic. Thank you, Daniela, very much for a really brilliant talk, actually. And you covered a huge amount there. And I know that people will want to come in on various points. But, you know, listening to you talk, one of the things that one might take away from everything that you've told us today is that actually the financial system, so much by which I mean both the intermediaries, or what you call the financial institutions, and the central banks, are actually not serious about addressing the climate issue at all. Do you think they're serious?
I mean, yes, I think that's a very difficult question because, you know, they spend so much time engaging in or thinking through what they should do. And I have no doubt that privately there are lots of people in central banks in particular that are, and in private financial institutions, and I hear this from private financial employees who say, look, we are young, we want our kids to have a planet, and you know, greenwashing is there, we know about it, we know that more needs to be done, so we are serious about this. But I think the logic of my analysis and of the theoretical framework that I am using here is to say that there are structural constraints and political constraints that are, in a sense, influencing or modulating the nature of what it means to be serious when you're a central banker or private finance about the low carbon transition. And I guess the central banks would say, well, you know, maybe you are too impatient, Daniela, in the sense that this is in many ways a very contested avenue, or that we have chosen, because many people are saying, well, this is it's a political issue. An independent central bank has nothing to do with this credit allocation, right? Because for many central banks recognize that this means basically doing de facto industrial policy. It's favoring certain sectors and punishing other sectors. And this is in a sense completely inconsistent with central bank independence. So they are saying, well, we are very brave here. We are very ambitious. We are pushing where politicians are reluctant to push, and they can point to many politicians that are talking a lot more empty air than central banks do. This is what is possible. Unfortunately, I think, and this is something that has been bothering me because I've been studying central banks for a very long time, is that I have the sense of urgency. I was climate aware, but I was not scared. And now I'm scared.
Yeah,
and if one believes that the climate crisis is as serious as it is, and it's very difficult to ignore, I don't know how people who can ignore the very obvious signs, then you want them to be more ambitious. It's just, there is so much at stake that everybody needs to just be more ambitious. And this means that, you know, understanding political constraints is fine, but it's not enough.
Yes, but if we think about that point, precisely that point, so when you talk about de-risking, what this effectively means for all of these financial intermediaries is a kind of preferential selling. In other words, that you're saying to them, okay, you can go into this situation, but we're going to give you some backups. You're not going to actually pay the full cost of it. And that means that you will be able to carry on extracting the economic value from the system that has always been your desire, so that in a sense you will not be paying anything for the climate activity. But the people who will be paying are ordinary citizens, because the fiscal constraint on the governments that do this de-risking for the financial intermediaries is massive. Yeah? And that means that you get into a situation where, even if we'd listened to the Chancellor of the Exchequer saying that, you know, this is the end of austerity and a new productive Britain, et cetera, et cetera, et cetera. But the fact of the matter is that the British government, you know, apart from this windfall that we're currently talking about, won't be able in that scenario to put as much money into supporting public goods and public services, because it's doing something else with its money.
Well, this takes us into a very different avenue, in the sense, I don't know if you are familiar with modern money theory. I don't want to invoke them here, but there is a very serious question of to what extent is a government constrained in relying on its central bank in order to finance its own economic objectives. And I would say for the UK, for a variety of reasons, there is not a trade-off between de-risking and investing in public goods, right? Because you can have coordination between the central bank and the treasury, as we have had for the last year. I mean, if you look very carefully, Bank of England has bought almost every bond issued by the treasury and kept its costs under control. But of course, and I think this is where your question, for countries in the global south, it's a bit different.
That's right.
You are constrained in different ways. But of course, there is, your question is very important, because there is also a political aspect to how do we think about organizing public spending. And it's very clear that some political parties believe that there is a substitution. If you spend more money there, you can't spend more money here, right? Yeah. And in a sense, these two are politically inconsistent, even if not macroeconomically inconsistent. I would say macroeconomically, they are not inconsistent. You could do both de-risking and you could do investment in public goods. The problem is that in a sense, if I de-risk the more and more of social life and commodified public goods for the private financial system, how will I be able to also provide them publicly, right? This is it. They are not, these two solutions are also kind of ontologically inconsistent, right? Because if I say, well, it has to be private finance that builds my roads, and I will de-risk them, then if I start to build roads publicly, then I'm competing with them. So it's, and the European Commission, for example, know that they don't like that competition from the state. So you are right that they are inconsistent fundamentally, these two approaches, for a variety of reasons.
Yes, I agree. That's an interesting thing about macroeconomics itself, isn't it? And the way it interacts with treasuries around the world. Well, just before we open up to the floor, I mean, one of the things you talked about was the development of new asset classes. And I think that everybody listening to you this evening will understand your point that development itself has become a new kind of asset class. But I think what people listening may find harder to understand is the point you made, which is going to be very much asserted at COP26, not least because the British government has just published the Dasgupta review and a number of other things, that nature is becoming an asset class for these financial intermediaries. And I wondered if you could just say explain a little bit just for people how that process of nature becoming an asset class actually works. How does it work financially, if you see what I mean?
Yes, I think that's a very legitimate question. And for a very long time, I was also puzzled because the logic of the asset class is to say, okay, I'm going to invest in an asset that generates some cash flow for me, right? So government bonds are an asset class because I lend to the government and the government pays me, services the debt, it pays me interest on a regular basis. And at the end, it gives me my money back.
Yeah.
I invest in development asset classes because the company that is doing this PPP will get either user fees or you will get fiscal resources through the de-risking, and it will give me the cash flow. So I thought to myself, how does nature or investing, there are many different things that come on in under nature as an asset class, including whales, I don't know, now conservation parks I've seen. What is the underlying cash flow? This is the fundamental question. And my understanding so far is that there are two types of underlying cash flows, and one has to do with carbon credits, right? So you can get the carbon credit that you can monetize can become a cash flow. And the other one, and I think that the experience of Total in Congo is very interesting. Congo has a nature-based solutions unit, right? Total is a French fossil fuel company, oil company. Yeah. And what it says is, okay, we want to exploit, we want to have new oil fields in Congo, but we want to be socially and environmentally friendly. So what we will do is we will plant, or we will plant and do some carbon capture one way or another. And their solution to do that was to basically get 75,000 hectares of a natural savanna, and they want to replace the natural savanna with commercial wood, right? And from the exploitation of commercial wood, you generate the cash flow. And this to me is a very powerful example of how the logic of nature as an asset class can actually be, it doubles down as not only as more fossil fuels, but you also destroy local ecosystems in the process, while you can claim to the regulator that you're supporting nature. So it's something that I'm hoping, I understand there are PhD students here. I'm hoping that people will study more the way in which nature as an asset class functions as an ecosystem, but it's more and more there, and it's more and more. I would also assume that at some point governments will say, well, we will pay for it ourselves, you know. We will give you some cash flow in order to make sure that you don't destroy this area or you preserve it.
Interesting. Well, we wait to see. This is going to be a contentious issue, though, coming out of COP. I mean, you know. But let's open up to the floor because people are getting excited and want to ask you various kinds of questions. And I'm going to start with the first one that I have in front of me, which is from Mara, who's saying, in these financial strategies towards risk, how do you see the growing interest, as evidenced by the World Bank and the IMF, to develop catastrophe bonds for sovereign disaster risk transfer in the context of climate extremes? And what role can this play towards debt or the debt of disaster-affected countries?
Well, I mean, my knowledge of catastrophe bonds is that they were a sham, in the sense that the World Bank was actually never able to get countries to receive compensation from catastrophe bonds. So I would say it's just one other financial instrument that turned out to be a nice source of profits for the private financial system, but not a source of insurance for the state. Yes, I think that's exactly how a lot of people feel. And following up on this, on de-risking, then a question from Justin. So on the de-risking relationship, could this not lead to further concentration of power within private sector, who couldn't itself use this new position of de-risked investments, which are backed by developing South governments, to lobby agendas that could harm the country in the long run, or create monopolistic structures to crowd out the market? Thank you, Justin. I think that's a really interesting question. And there are, there are, let's say, a two-part answer. And the first part is to use the concept of infrastructural power from Ben Brown, and to think through the idea that as the state becomes more and more reliant on private finance to implement its social policies, right? Because if you organize, for example, your entire health system through PPPs, then of course you will rely on PPP hospitals to implement whatever your new health policies, including, for example, responses to new pandemics. So there is a danger that health policies and health measure or in general social policies, if you have private financial actors that are so powerful, it would be more difficult to pass or to introduce policies that are, in a sense, pushing back or against their interest or reducing their profits. The other part of the answer is that most of these PPP contracts have de-risking provisions for political risk. And once I understood what political risk meant, I found it quite, in many ways, both appalling and fascinating that this was possible. But if there are countries that are signing PPP contracts with private providers that say, well, if we decide to raise minimum wages one day, we will compensate you for it, right? So in a sense, climate policies or wage policies or nationalization policies, any of these are viewed as political risks for which the private sector or the private actor in a PPP will be compensating. So the logic of de-risking is yes, is going towards creating monopolistic structures, but it's also going towards tying the hand of the state in changing policies in the future, right? So if you have new governments or new political parties that have different political logics, it will be far more difficult to try to implement these new policies, particularly in a space where you have ISDS, where you have bilateral investment treaties, and where you have private arbitration courts where private actors can sue governments far more easily than in the past. So I think you're right about that it could lead to creating monopolistic structures. I think one of the things that I want to study more is to look at the contracts for renewable energy. I think that's where my argument, in a sense, needs to be tested a bit further, because if you talk to people, well, I guess to governments and to private investors in the global south, what they will say, okay, maybe you're right about Ghana or Nigeria and their fossil fuel de-risking. That was outrageous. I also agree about health. I also agree about education. But what about renewable energies? And look at the Kingdom of Morocco. The Kingdom of Morocco has done several PPPs, and it's built the largest renewable energy plant, solar plants in the entire Africa. Why is this not a good example of de-risking? And if you look at Morocco, I think that's a very interesting example, because if you dig down deep down into it, you will see that somehow the Kingdom of Morocco is de-risking a PPP project, a renewable or a solar energy plant that is much more expensive and has outdated technology. They basically bought the worst renewable energy, the worst solar energy possible, to the extent that I understand it. But the documents that I've seen suggest that it's not only very water intensive, but also that it's very expensive. So the Moroccan state is paying through his nose in order to de-risk or to compensate the private operator of the solar energy plant, which is incidentally a Saudi Arabian company. There is a whole geopolitics going on there that would be really interesting to study, because this is not only Wall Street. I mean, the Wall Street consensus is not only, big bad American finance doing things, but it's also a lot more. There are also very interesting regional dynamics. And I'm not sure that they benefit the citizens, which to me is the important question.
Yes, I agree. So now we've got a couple of our panelists who are on the panel, so they can ask the questions themselves. And the first one is Chris, and the second one is Andrew. So let's go to Chris first, and then we'll come to Andrew afterwards, and then back to the students.
Thank you, Henrietta. Thank you, Daniela. A really wonderful talk. So many questions. I'll limit myself to two, because I can see there are many more questions. So the first one is of an empirical nature. you sort of briefly mentioned that, or I'm kind of assuming that COVID highlighted the high cost of these demand risks and de-risking. So has that process not kind of scared some nation states off? And you mentioned on the last slide, Chinese development finance, is that offering an alternative? The second question was more conceptual. A lot of what you've been talking about in terms of the power hierarchies and relationships and the kind of geographies underpinning them sound very colonial. It is the concept of colonialism, which is not one you use. Are there reasons why you wouldn't use that in this context? It seems like it might be appropriate.
Thank you. No, I mean, to the second question, yes, but I would say I don't want to be a white person that just throws the colonial at everything that I do, because I don't think that I understand it sufficiently. But there are scholars who are doing research in this tradition that are looking at the kind of colonial and post-colonial dynamics of value extraction that are going on there. Because to me, this can also be read as a project of extracting value from the South, from citizens in the global South, for a very small handful of 0.1% in the global North. And I say this as in a sense because one can also think, well, it is my pension fund, and your pension fund, by the way, probably is invested or is giving money to financial institutions that are searching and constructing development as an asset class. Only that I think it's fair to say that at least in higher education, we do not see the benefits of this post-colonial extraction process, in the sense that it doesn't reach us. So the system doesn't work for citizens here either. So yes, there are people, a former colleague here who's now moved to the US, Keston Perry, is working on that and has written some really interesting stuff. I mean, the logic of the process is colonial. I don't use it because I want to be more respectful with the term and understand it better. On scaring the nation state, I think, I mean, in a sense, there are balancing scary factors going on, particularly for poor and middle income countries, in the sense that on the one hand, of course, you see that the risking costs are higher. You see the World Bank, and incidentally, I didn't have time to elaborate, but it's fascinating that the World Bank has spent a lot of time basically putting in place a PPP office in every country that I can think of in the global South, and making sure that, you know, there is a technical apparatus that accompanies the de-risking state, not accompanies it as in to try to minimize the de-risking costs for the state, but in terms of being able to set up, you know, the processes and the projects, because one of the problems of the Wall Street consensus is that the ambitions are not matched by reality, since these PPP projects are very expensive, they take time, etc. So I would say there is a realization that these are expensive, but they are balanced and in a sense outweighed, I think, by the narrative that countries in the global South don't have money. So if you say the state has very limited fiscal resources, the state has a lot of external debt pressures, and then you have the Wall Street consensus logic coming and saying, well, these will be contingent liabilities. You don't have to pay anything now. You only have to commit to compensate us if things go wrong. This is the logic, right? I mean, you don't pay, you pay some, of course, but the de-risking part is if risks materialize, you compensate us. And politicians, particularly in electoral cycles, if you have a very large kind of infrastructure project, which is very attractive, and you can look at Kenya, there are so many examples of PPP going on there, or of francophone countries in Africa, and I've been working on this with a colleague from Senegal. Just as here in Europe, the attraction is to say, well, you know, the private sector will build it, we have the investors who will finance it, and we might have to pay for it, but maybe not we, maybe somebody else. So the political incentives there are for politicians to say, this is a problem for the next administration. I will just like, they left it for the Labour Party, I will just leave it on a piece of paper.
Yeah,
very problem, not mine.
Very difficult. Okay, let's turn now to Andrew. Andrew.
Hi, Daniela. That was a fantastic talk, and I've been following your stuff on the Wall Street Consensus. It has similar, and you just mentioned pensions, right? It has a similar narrative to something that's been going on for 40 years, where we originally outsourced old age security effectively to the private sector. And in fact, that created the large financial institutions that are now dominating this. So one question that strikes me is to what extent do you think that these problems in ESG and climate finance are actually kind of natural outcomes of having made decisions to outsource other things in the past, particularly old age security, and to what extent are those two connected? So if we actually want to deal with these problems, do we have to definancialize, and does that mean we have to reshore or re-own Social Security in a way that means that these financial institutions don't have $100 trillion that is sitting there waiting to be directed? So that's my first question. And the second one, so that I don't have to come on afterwards, was we've had very interestingly, the head of ESG at BlackRock turned into a whistleblower lately. And his contention is that the primary problem is that these institutions will not actually finance climate, that they will greenwash, they will delay, and therefore this outsourcing to private finance is not even going to work. And I wondered whether you had a comment on when we'll know whether that's true.
Thank you. Gabriella.
Thank you. So I've been following the debates around the BlackRock's head of ESG, because it's one thing that I criticize ESG, another thing that the head of somebody who's managing almost 10 trillion in assets and who's an ESG evangelist, at least institutionally, comes out and says this is nonsense. But to me, I think the question, I mean, the way that he framed it is a micro view, right? And the microeconomics of this is, well, will it be profitable or not? And this is what you see a lot in the ESG space is, well, we don't have kind hearts, or this is not for impact investment. We have mandates. We need to deliver to our shareholders. If ESG works, okay. If it doesn't, we will do something else. And I think, to my mind, that is fair enough. I think that we shouldn't expect private finance to deliver public good outcomes, including a low carbon investment. This, particularly if we take seriously the climate crisis, then this is something that it is a public responsibility of elected politicians and state institutions. So I want to move a little bit away from that. Will it or will it not happen by itself in the private sector? Because we know that also, and if you look at what happened over the last month and a half, which has been very destructive in many ways for a lot of good intentions, is that when there are signs of energy pressures, and then everybody loves fossil fuels again very quickly, right? So in a sense, if you choose to see the last 6 weeks as evidence that we cannot rely, and this is how I choose to see, that we cannot rely on private markets to generate the kind of price signals that will increase massively investment in climate finance and will decrease investment in fossil fuels, then I don't think it's that relevant a question, or framing the way that the ex-BlackRock whistleblower did it. I think it's just, you could also think of greenwashing as a strategic move from private finance, because they listen very carefully to what central banks say. And when you hear Mark Carney saying there is a Minsky moment coming and we need to do things, you also start to get worried that maybe this time they will be serious, because you have kids in the streets on every Friday banging on the door and saying, what are you doing, guys? Hello, we are going to die. Can you please mobilize political will? So in a sense, it's not only a question of returns, it's also a political strategy. To me, ESG is a political strategy to say, you don't need to regulate us because we're doing it already. Okay, and I think it has been quite successful. And if the climate risk approach remains the dominant approach in central banking, then then yeah, it's a political win for private finance. And this takes me to your first question, whether this is a natural outcome of the way in which we have organized. I think my wholehearted answer is yes. I've been thinking about this also because I've been studying for the last time, just finishing a report on the role of institutional landlords in Europe, the way in which more and more of our residential units are held by private financial institutions and rented out. And, you know, we typically point to private equity companies and we say, oh, private equity companies are evil, you know, Blackstone is evil, and they may or may not be evil. I mean, they just need to make money. But what is behind them is pension funds. I mean, they are basically using the money that I am sort of contributing to because I am worried. And this is a consequence of the way in which the social contract between the state and the citizens has been changing over the past 30 years. We have collectively saved through the state, and we have provisions for future uncertainties through the state. And then we move toward provisions through the market. And if you move to provide for the future through the market, then you have this kind of unintended consequences, simply because, of course, pension funds are right. They need to have some return so they can pay their pensioners. This is how the logic of the system is. And the only solution to this, but try to sell this politically to somebody, is to say, we need to nationalize pension funds. Then you will solve the private equity problem. Then you will solve the asset management problem. But who wants to? I mean, Orban wanted to, in Hungary, manage to nationalize some pension funds, but you don't want to have a very conservative politician doing the kind of things that, well, at least I don't, doing the kind of political measures that are necessary.
Yes, it's a tricky question. Now, let's turn to Andres, who's with the students. Andres, can you hear me? And can you give sight of everyone who's with you for Daniela? Yeah, there we are. There are the students who are there in person, right? Because we're fully hybrid this evening. So, great. Okay, so let's see who's asking the first question.
Hello, Daniela. Thank you so much for this wonderful talk. We have a first question from Flavia.
Hello, Daniela. My name is Flavia. Mine is really more of a concern than questions, and I'm going to make reference to the first part of the presentation, which mentioned the 100 billion investment, and along that, which obviously was developed by developed countries, endorsed by developed countries, and alongside that, we saw four image pictures of chief executives of big companies, Gold, Smart, and all that. I'm concerned that all this big investment, big finance, is kind of deliberately ignoring the people that are affected most, like in Africa, where climate change, the Africa its contribution to carbon emissions or climate change is minimal, and yet is affected most by climate change. I'm worried that this whole thing, it may look like, it's a whole, looks positive, but how the fact that Africa, for instance, is not involved in any way, for instance, in using the knowledge, like indigenous knowledge, because as Africans, we have indigenous knowledge that I think any investment or any company that is looking into investment, they should be using this knowledge to kind of and incorporate it into their business plan. I'll give an example. I come from a small kind of tribe where there is a bird that when I was young, we were growing up, we used to sing about it as a bird that gallops water. That bird is classified as human. And when it dies, it's given a funeral like a human being. And if anybody kills it, they'll be considered a murderer. This kind of information, of course, Africa, of course, where I come from, I don't want the environment that bird, loses that bird so that it will be extinct. So I won't have any relationship with it. That kind of knowledge and more that I can't talk about now is ignored as far as, these investment plans, huge investment plans are concerned. And actually that brings me to the next question. The presentation itself had a lot of systems and structure, which to me takes us back to colonization. Here we see kind of some white supremacy, setting up all these policies and all, but it's basically, from the West, and literally trying to impose it, and to people in the South. How do you imagine that kind of challenge, can be addressed? If I can probably put it that way.
Thank you, Flavia. Yeah.
Thank you. So these are quite difficult questions. So let me try to answer them. I think on the question of who is making decisions at COP26, I would very much agree with you that there is an imbalance of representation, and countries, I mean, middle income and low income countries, if their representatives manage to make it here, and it's not very clear to me that they will be able to, because of, or they might want to, because things are pretty chaotic in the UK, at least in relationship to COVID-19, you will probably know. They certainly do not have the kind of seat at the table that we think that they should have, given the way in which the climate crisis is affecting them without these countries having contributed. And this is why I think this concept of, or this possibility of carbon shock therapy is quite, in a sense, quite worrying a development, and we have to think about it carefully, because if there is some form of a political agreement from high-income countries, I don't like to call them developed, because we shouldn't call countries that have produced the climate crisis developed. They have, in a sense, the development has also meant that they are contributing, that they have generated the kind of problems that we are looking at now. So I call them high-income countries just to describe the fact that they have more income per capita than others. Yeah, going back to high-income countries, have not, in a sense, I don't think that it's difficult to talk about the subject of reparations. There is a debate around subject of reparations. We have seen that the 100 billion a year are not there forthcoming yet. And there is also the question of how this 100 billion will actually be directed towards countries in the global South. How much will be grants and how much will go into de-risking? And my worry is that a lot more will go into de-risking. And here, and I think this is, in a sense, a legitimate question that you also asked, that I have to ask myself, which is that, am I portraying, because my story is about, you have this political alliances being formed with countries in the global North and very powerful systemic global financial institutions, and I'm portraying countries in the global South as the victims of a system that they are part of, but they do not influence in any way, but they kind of get systematically screwed in it, right? This is kind of the story that I'm telling. And I want to be careful not to victimize countries there, because there are all sorts of local political dynamics. And in the paper, I also make an argument that, not every country in the global South, and you're right, not every country in Africa has seen the same dynamics or has embraced de-risking in the same way. I mean, Ghana has and Kenya has, but Namibia, to my knowledge, not so much. South Africa has. There are genuine questions to ask there. Whether, I'm afraid that indigenous knowledge is not a very useful, at least in the logic of the system, is not very useful to generate returns. And I would be worried if it was, in some ways, if somehow private finance finds a way of monetizing the bird that you're discussing, then I don't know, it probably will mean that more birds will die or something. I don't want them to be in charge of nature, because I don't think the incentives are there for them to be careful custodians of nature. But I would encourage you to think through, what would it mean to have indigenous knowledge as part of this system? How would that work? I don't have answers, also because I don't know enough about it. But it would be interesting to think how there could be, what kind of mechanisms through which indigenous knowledge would either work to protect some parts of some countries, or to redefine the relationship between countries, or to challenge the local politics in a way that is not so amenable to the kind of transnational political alliances with global finance. There are lots of very interesting questions there, and that takes me back to the question of post-colonialism. And I think you're right. I mean, you're right in the sense that there are similar but different patterns of value extraction and different patterns of subjectification. But I cannot speak so much about it. There is somebody, Max Ali, I don't know how you pronounce his name exactly, that has written about People's New Deal. And I would suggest that you read him. He's a Tunisian scholar that is looking from this perspective of trying to challenge a little bit this kind of global north perspective that, in a sense, I'm also reproducing in some ways.
Right. Okay, that's very good. Now I'm a little bit mindful of time, and so Conrad, do you have a second question there? Second questioner?
Question from a student?
Yeah.
We don't have a second question from a student, but there can be a second question from me.
Okay.
Daniela, you mentioned green shock therapies and the lessons that can be learned from China. Could you expand a little bit on this?
You maybe not now. So I was thinking carbon shock therapy in the sense of trying to isolate and think about why is it that everybody as in the institutions that are mobilizing and pushing the Wall Street consensus, why is it that they prefer hikes in carbon prices as opposed to other measures to decarbonize economies, right? Mm. And the idea of the carbon shock therapy, which I'm hoping to develop with Isabella Weber, because she knows a lot more about China, is to look at the ways in which China escaped shock therapy in the 1980s by refusing to play, or by experimenting with changes in price signals, but on a much smaller scale, and within a logic of state-guided industrial policy and state-guided industrial transformation. Carbon shock therapy doesn't have the state guiding much, except to saying it will be much more expensive for you to pollute, and from now on, may the market deliver, or may the market transform. And I think that's particularly for poor countries and middle-income countries, if you just change price signals, what we might see is a second wave or a third wave of structural adjustment programs, where the existing or new productive capacities are going to disappear or be destroyed simply because it's very expensive. It will become very expensive to produce if you don't have the technologies for low carbon, the low carbon technologies for production. Or areas like the European Union will say, well, a border carbon tax, which is, we will not allow you to compete with our producers, whom we are punishing already by making it more expensive for them to pollute. So that's the logic of the carbon shock therapy, is to think through what are the macroeconomic and political consequences of a growing political consensus around increasing carbon prices, as opposed to other things that we could do.
Right. Okay, that's very clear. Thank you. So I think we have time now for two more questions, although there are lots more questions, but let's start first of all with the one from Almira, which is in front of me. And she's saying, what contributions can the Wall Street consensus make to the financial inclusion endeavor, if any? And isn't de-risking going to promote more exclusion of poor countries and populations?
Well, thank you. I mean, it's going to my mind, it could produce potentially more social exclusion because of the way in which we commodify or have privatized public goods. And I've given you a list there of all the public goods that the World Bank and the IMF and the institutions of the Wall Street consensus are hoping that will become investable development assets. So there is a pattern of exclusion there. And then there is the question of financial inclusion, which I think is kind of separate, but also interesting, because that is, to me, you can also see particularly the digital financial inclusion agenda as a project of making the poor into an asset class, right? Which is to say, okay, we cannot lend to the poor because they don't have a collateral. We don't, they cannot take a loan for, I don't know, consumption or for anything, because we don't know, we can't have a credit risk profile for them. But once you have a mobile phone, then you have a digital footprint that can be fed into a credit risk profile, and then can be used in order to make sure that you become a worthy subject of credit and you become an asset class. And then Susan Soderbergh has written more about how this also kind of fits with much more complex financial instruments. So I read it in that perspective, but you can also read it in the way in which, for example, health is becoming increasingly digitalized. So private health providers are increasingly reliant on digital instruments and digital spaces. I mean, I don't know. I'm being serviced by the NHS. It feels we don't have access at all. But if in other countries, particularly in poorer countries, the private health system is much better at combining this financial inclusion with access to commodified health.
Yeah. And then the last question, and then it's been a long session. Thank you very much for your time and patience. From Arian, and he's saying, with TCFD disclosures becoming mandatory by 2025 in the UK, this is supposed to help with the greenwashing from private finance. But even after disclosures, does this really decarbonize the financial system at the rapid speed that's necessary to avoid a climate crisis from temperatures exceeding 1.5 degrees above historic levels? So.
I mean, to my mind, the short and maybe not very sophisticated answer is no. I don't think that the disclosures under the TCFD framework, even if they become mandatory, and that's a good step forward, but to my mind, they are not granular enough, and they are not organized in a way that would allow particularly financial regulators to identify and to think that this will lead to decarbonization, right? Just knowing what is on your balance sheet and the way in which TCFD works is not exactly that, is not enough. And this is why for the central banks are some of them in the business of trying to decarbonize the financial system, simply because disclosure of particular types of risk under the TCFD framework are not enough to generate greening.
Well, what a fantastic session we've had, Daniela. Thank you very much. You generated huge amounts of excitement from everyone, and we really, really enjoyed it. We look forward to hearing much more about your ideas after COP26 has happened, and also with how the new ideas about the carbon shock therapy pan out. It's been a great pleasure to have welcomed you to the IGP. And the panelists, can you turn on your videos, please, panelists, because we're actually able, and the students as well, to give you a round of applause, which is both hybrid and virtual. So thank you very much indeed.
Thank you very much. It was a pleasure, and I hope you.
Yes, I hope to see you. We hope to see you again very soon. Thank you very much. Okay.
Yeah,
Bye, everyone. Bye.
Bye.